Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to revise the remaining concepts of the capital gain chapter. This is part 2 of the revision lecture. If you have not watched part 1 yet, I would recommend you to first watch part 1 of the lecture and then continue with part 2. Fine. Now before beginning the revision, my as usual request to you is to like this video, subscribe this channel to keep getting updates, and also leave a comment if you found this video helpful. So now without further ado, let us start with the revision. So first special concept is that we are discussing will be the exceptions to the charging section of capital gains. What does the charging section of capital gain say? That there should be a transfer of a capital asset and capital gain will arise in the year of transfer. But there are a few cases where capital gain will not arise in the year of transfer, but it will arise in some other year. Okay, so what are those cases? Let us see one by one. So first case is Section 45 subsection 1a. Section 45 subsection 1a talks about insurance claim received for damage or destruction of a capital asset. If a capital asset is destroyed due to fire, flood, earthquake, tsunami, riot, civil disturbance, enemy attack, or any other natural calamity, then if the insurance claim is received, so what will be the year in which transfer happened? The year in which transfer happened will be the year in which the capital asset was destroyed, because even destruction is transfer. Okay. However, the capital gains will be taxable in the year in which the insurance claim is received by the assessee. So how to calculate the capital gain? Take the full value of consideration as the insurance claim received. Insurance claim can be in money form also, or it can be in asset also. Take, if it is in asset form, take the fair market value of the asset as full value of consideration. Then as usual, reduce the transfer expense, cost of acquisition, indexed cost of acquisition, cost of improvement or indexed cost of improvement. You will find the short term or long term capital gain. Okay. If at all no insurance claim is received, if no insurance claim is received, there will not be any capital gain. Fine. Now let us come to Section 45 subsection 2, conversion of capital asset into stock in trade. So when a capital asset is converted into stock in trade, then the transfer arises when the conversion takes place. The transfer arises when the conversion takes place, but capital gain will be taxable in the year in which the stock is sold. In the year in which the stock is sold. And if a part of stock is sold, then only for that part of stock only capital gain will be arising in the year in which such part is sold. So how to calculate the capital gain? First, take full value of consideration as the fair market value on the date of conversion. Then you have to reduce as usual cost of acquisition or indexed cost of acquisition, cost of improvement or indexed cost of improvement, and you will find out the capital gain. This fair market value only will become the cost of the stock in PGBP income. Okay, so while how to calculate PGBP income? PGBP income will be selling price of the stock minus fair market value on the date of conversion. We will get the PGBP income. Now both capital gain income as well as PGBP income, both of them will be taxable in the year in which the stock is sold. In the year in which stock is sold. Okay. Then what about the reverse case? What about when stock is converted into capital asset? So when stock is converted into capital asset, what happens? Firstly, you have to find out the PGBP. PGBP will be what? For calculating PGBP, take the selling price as fair market value on the date of conversion, and cost price should be taken as the actual cost price. You will get the PGBP income. Here no kanna, PGBP income is taxable in the year of conversion itself. It is taxable in the year of conversion itself. Then what about capital gain? In capital gain, full value of consideration will be as usual, the selling price, and then you have to reduce the cost of acquisition. What is the cost of acquisition? Cost of acquisition will be fair market value as on conversion date that you took for PGBP calculation. Okay, and then you have to reduce it, then you can find the capital gain. Capital gain will be taxable in the year of transfer. So now both cases we have seen, conversion of capital asset to stock in trade and stock in trade to capital asset, how it will affect in the assessee's head of income. Now let us discuss section 45 subsection 5, that is compensation on compulsory acquisition. Kana, what is compulsory acquisition? When the government is coming and compulsorily acquiring the property of the assessee, it is called compulsory acquisition, and it is also a transfer. So hence when government is acquiring the property, the assessee whose property has been acquired by the government has to pay tax under capital gains. Okay. Now there is section 10 clause 37 which is providing an exemption. What is an exemption? if at all the land that is compulsorily acquired is an urban agricultural land. If the land that is compulsorily acquired is an urban agricultural land, and if three conditions are satisfied, then the compensation on compulsory acquisition will be fully exempt. What are the three conditions? Condition number 1. This exemption is available only for individual and HUF. Condition number 2. The agricultural land shall be used at least for 2 years, either by the individual himself or by the parents or by the HUF. It should be used for agricultural purpose at least for 2 years. And third one, the consideration should be determined and approved by the RBI or the central government as the case may be. If all these three conditions are satisfied, then compensation received on compulsory acquisition of urban agricultural land is fully exempt under section 10 clause 37. The remaining provisions, the remaining cases where compulsory acquisition money is received, it will be fully taxable under capital gain. However, listen, when does the transfer take place? The transfer takes place when the land or building is compulsorily acquired by the government. However, the capital gains tax will be payable in the year in which the compensation is received by the government. And in compensation also there are two types Kanna. One is initial compensation and one more is enhanced compensation. What is initial compensation? Initial compensation means the government themselves are coming and giving the compensation. It is called initial compensation. If initial compensation is received in installment, then entire amount will be taxable in the year in which the first installment is received. I gave you example also. So for example, if in initial compensation I am getting 40 lakhs in year 1, okay, then 50 lakhs in year 2. In such case, what will happen? The entire amount of 90 lakhs will be taxable in the year 1 itself. The entire amount will be taxable in the year in which the first installment is received. Now let's talk about enhanced compensation. Enhanced compensation means what? The assessee is going to court against the government, and then the court is asking the government to pay some extra compensation. This extra compensation is called enhanced compensation. Enhanced compensation is always taxable as and when received. So if for example in year 1 40 lakhs is received, then 40 lakhs will be taxed in year 1. In year 2, if 45 lakhs extra is received, then this 45 lakhs will be taxable in year 2. So in that year it will be taxable. Enhanced compensation. And enhanced compensation also can be due to interim order, or it can be due to final order. If enhanced compensation is received due to interim order, then it is not taxable in that year. It is taxable only in the year in which the final order is passed. In which the final order is passed. You get my point? Now how to calculate the capital gain? Capital gain, you take full value of consideration as the entire initial compensation. From that initial compensation you can reduce as usual transfer expense, cost of acquisition, indexed cost of acquisition, cost of improvement or indexed cost of improvement as the case may be, and you will find out the long term or short term capital gain. Now let's come to enhanced compensation. When the enhanced compensation is received, full value of consideration will be the enhanced compensation amount. But you cannot reduce the cost of acquisition because cost you already reduced while calculating the capital gain on initial compensation. That is why you cannot reduce it once again. So what you can reduce? You can reduce only the transfer expenses. For example, the litigation expense. The expense that you are giving to court of law or you are giving to lawyer, that is transfer expense, you can reduce it, and only on the remaining amount it will be considered as long term or short term capital gain or capital loss. Okay, so this is how you have to calculate. And one more point, if an assessee is getting enhanced compensation, he might also get interest on enhanced compensation. Such interest on enhanced compensation is also taxable in the year of receipt. It is covered in income from other sources chapter, and 50% standard deduction is allowed against the interest on enhanced compensation, that we will learn in income from other sources chapter. Now let us come to the remaining next types of provision. Firstly, let us see what will happen when there is transfer of X security in a Demat account. Now listen here. Earlier there used to be a system of physical shares, means shares was received as share certificate. So when I sell the share certificate, I will receive the money and I will pay the tax under capital gain. But now what has happened? Shares are coming in digital form in dematerialized account, okay, or Demat account. And now I have to approach a broker. Let's say I am approaching a broker named Zerodha. Zerodha is only buying the shares on my behalf and he is keeping the shares with himself. Now, on paper, Zerodha is the owner of the shares. However, I am only the beneficial owner of the shares because I have only bought the shares through Zerodha. That is why capital gain is applicable in the hands of beneficial owner. That is in my hands. Zerodha need not pay any capital gain. I only have to pay capital gain because I am buying the shares through Zerodha. You get my point? Now, when it comes to Demat account, it is very difficult to differentiate the securities from one another because all the securities are mixed up and stored together in digital form. That is why when we are selling the security, when we cannot track which security we are selling. That is why in case of sale of security, we have to calculate the selling price, the cost of acquisition using the FIFO method. So cost of acquisition and period of holding in case of Demat securities are calculated using FIFO method. What is FIFO method? First in, first out method. First in, first out method. And what if there are more than one Demat account? If there are more than one Demat account, then for every Demat account you have to calculate the FIFO method separately. Okay, FIFO method separately. Now let's come to section 45 subsection 3. What happens when capital asset is transferred from partner to a partnership firm or from a member to AOP BOI? So if a partner transfers a capital asset to a partnership firm or member transfers to AOP BOI, then capital gains is taxable in the hands of the transferor, that is the member or a partner, member or partner. Full value of consideration should not be taken as the sale value. Full value of consideration should be taken as the amount recorded in the books of the partnership firm AOP or BOI. You get my point? So take the full value of consideration as amount recorded in the books. If at all it is a case of immovable property which is transferred from partner to partnership firm or member to AOP BOI, then if stamp duty value is more than the amount recorded in books, take the stamp duty value as full value of consideration. If stamp duty value is more than the amount recorded in books, take the stamp duty value as full value of consideration. Now let us see the reverse case. Section 45 subsection 4. What happens when capital asset from a partnership firm AOP or BOI is transferred to a partner or a member, as the case may be? In such case, the firm or the AOP BOI has to pay the tax under capital gain. For that, take the full value of consideration as fair market value on the date of transfer. What is the full value of consideration? Fair market value on the date of transfer. Now let us come to next section, that is section number 46, distribution of assets by a company on liquidation. So what is liquidation? Liquidation means in simple terms the company is closing down. Hence when the company is closing down and after all the liability is over, whatever balance asset it is having, it will distribute the assets to its shareholders. The balance asset it will distribute to the shareholders. Now listen here. When let's say this is the balance sheet of the company, here general reserve is there. What is general reserve? It is nothing but accumulated profit. Okay, accumulated profit. So general reserve is there. Let's say the general reserve is 100 crores. Okay, and let's say there are assets worth 200 crores. Assets worth 200 crores, and for this company there are 4 shareholders, namely A, B, C and D. So now all the liabilities are over and this asset worth 200 crores are distributed to A, B, C and D of 25 crores each. 25 crores each. So what is this called? This is called distributing the asset on liquidation. Distributing the asset on liquidation. Now listen very carefully. When the company is giving its asset on liquidation to the shareholder, then this asset is transferred to the shareholder, correct? So should the company pay capital gain? Answer is no. Company need not pay any capital gain because this transaction is not regarded as transfer. As per section number 47, this transaction is not regarded as transfer, so the company need not pay any capital gain. But when the shareholders are receiving the assets, the shareholder has to pay two types of tax. The shareholder has to pay two types of tax. Okay, first is what? Deemed dividend. Deemed dividend. Deemed dividend we will learn in income from other sources chapter. There also I will be telling you the same point, that when a company is giving its assets to the shareholder on liquidation, then to the extent of accumulated profit, the distribution of shares will be called deemed dividend. Now listen here. This asset is how much? 200 crores. General reserve is how much? 100 crores. So it is 50%. That is why whatever asset is distributed, out of these assets, 50% will be from accumulated profit and balance 50% will not be from accumulated profit. Hence, listen here, 12.5 crores, which is 50%, will be deemed as dividend. Balance 15% and it will be taxable in income from other sources. 12.5%. It means the distribution of asset up to the accumulated profit of the company will be called as deemed dividend and it will be taxable in income from other sources chapter. Now what about the balance 50%, that is 12.5 crores? This 12.5 crores will become the full value of consideration. Will become the full value of consideration. But why sir full value of consideration? Because see Kanna, when the company is closing down, the shareholder will lose his shares. The shareholder will lose his shares. So this is also transfer because the shares are getting elapsed. It is relinquishment. It is also transfer. Since it is a transfer, for the shares that are going away, the full value of consideration will be the money, extra money that is received by the company, that is 12.5 crores. From this, he can reduce the cost of acquisition, indexed cost of acquisition, cost of improvement or indexed cost of improvement as the case may be, and he will find the capital gain or capital loss. You get my point? Sir, what if over and above the accumulated profit no money is received? If over and above the accumulated profit, if no money is received, then there will not be any capital gains also in the hands of shareholder. You get my point? So listen here, now you will be able to understand. See here, when capital assets are distributed by the company, in the hands of company, distribution is not a transfer and hence no capital gains tax will arise. But when the shareholder is getting the amount, distribution attributable to the accumulated profit of the company will be deemed dividend under section 222C and it will be taxable under income from other sources. Then whatever is the balance amount, that is the money received plus fair market value of the asset distributed minus deemed dividend under section 222C will become the full value of consideration for capital gain purposes. This is the concept of liquidation. Now let's come to section 46A, which talks about buyback. Sir, what is buyback? Kanna, when the company is buying its own shares back from the shareholders, it is called buyback. So for example, Infosys company is announcing buyback. It means what? It will buy its own shares, that is Infosys shares from the shareholders, it will buy and it will give money to the shareholders. This is called buyback. So now there are two types of buyback treatment. Firstly, we will see for domestic company, then other than domestic company. If there is a domestic company, it can be listed or unlisted, it does not matter. If it's a domestic company, then what happens? When the company is giving the money to the shareholder, then from that money it has to pay buyback tax. So listen here once again. Listen. If there is a company, the company is giving money to shareholder, okay, and shareholder is giving the shares back to the company. Then on this money, the company has to pay buyback tax. So what is buyback tax? Buyback tax is equal to 20% plus 12% surcharge plus 4% health and education cess. What did I tell? 20% plus 12% surcharge plus 4% health and education cess. So totally it will come to 23.296%. This is called buyback tax. So company will pay the buyback tax and balance amount only it will give to the shareholders. Now listen here. See, shareholders are getting the money from the company, correct? Shareholders are getting the money from the company and they are giving the shares. Shareholders are getting the money and giving the shares. Hence the shareholders have to pay the tax under capital gain, correct? But since the company has already paid buyback tax, no capital gain will arise in the hands of shareholder. The capital gain is exempt under section 10 clause 34A. So shareholders need not pay any capital gain tax. It is fully exempt under section 10 clause 34A because the company is paying buyback tax in case of domestic company. Now what about other than domestic company? If a company is other than domestic company, then while giving the money to the shareholder, company will not pay any buyback tax, but shareholder has to pay tax under capital gains. How will he pay tax under capital gain? Full value of consideration will be the money received by the company minus cost of acquisition will be the purchase price of the shares. By doing this, he will calculate the capital gain. On such capital gain, he has to pay the tax under capital gain head of income. You get my point? Then even in case of ESOPs bought back by the company, if the company is buying back the specified security and giving the money to the employee, in such case, the company need not pay any tax. When the employee is giving the shares back to the company, the employee need to pay the tax under capital gains. Okay. So how to calculate the buyback tax? Buyback tax will be calculated on the buyback amount. What is the buyback amount? Buyback price minus issue price. So do buyback price minus issue price. On that you have to calculate 20% tax plus 12% surcharge plus 4% health and education cess. You get my point? I hope you are clear with buyback provisions. Now let us come to section 50B, slum sale. Very important kana, section 50B, slum sale. What is slum sale? Slum sale means an entire undertaking of a company is sold as it is to another company, okay, for a lump sum consideration without giving individual value to each and every asset. So I give you an example. See here, Titan Limited is there, no? It is having a brand called Tanishq. This Tanishq brand, if it is selling to Kalyan Jewelers, then it is called slum sale. And from Kalyan Jewelers, it is receiving 1000 crore rupees. From Kalyan Jewelers, it is receiving 1000 crore rupees. And what are the value of the assets that are transferred to Kalyan Jewelers? The value of the assets of Tanishq Limited transferred to Kalyan Jewelers is 800 crores. 800 crores. So listen to me once again. Titan is having a brand called Tanishq. This brand of Tanishq, it is selling to Kalyan Jewelers. For how much? 1000 crores. But what is the value of the assets that are there in Tanishq? It is 800 crores. 800 crores. This type of transaction is called slum sale. Slum sale. Now how to calculate the capital gain in case of slum sale? Firstly, you have to take full value of consideration. For full value of consideration, earlier you used to take lump sum consideration, but now you should not take lump sum consideration. What you should take? You should take fair market value as per Rule 11 UAE. Fair market value as per Rule 11 UAE. What is fair market value as per 11 UAE? Very simple. It is fair market value number 1 or fair market value number 2, whichever is higher. Fair market value 1 or fair market value 2, whichever is higher. Sir, what is fair market value 1? Fair market value 1 is fair market value of the assets that are transferred. Fair market value of the assets that are transferred. What is fair market value 2? Fair market value 2 will be the fair market value of the consideration that is received. So in my example, see, what is fair market value 1? Fair market value 1 will be called 800 crores because it is the value of assets of Tanishq that are transferred from Titan to Kalyan. Okay. Then what is FMV2? Fair market value 2 will be 1000 crores because this is the fair market value of the money that is given from Kalyan to Titan. You get my point? So whichever is higher. In my case, which is higher? Answer is 1000 crores. So 1000 crores will become full value of consideration. From full value of consideration, you have to reduce the transfer expenses. You will get the net consideration. From net consideration, you have to reduce the cost of acquisition. Now, sir, what is the cost of acquisition? Cost of acquisition is the net worth of the undertaking. Net worth of the undertaking. In my example, it is the net worth of Tanishq. Net worth of Tanishq will be the cost of acquisition. Now, how to calculate the net worth? Very simple, Kana. Net worth means asset minus liability. Net worth means what? Asset minus liability. So in case of asset, if the asset is a depreciable asset, then don't take the book value, take the WDV, opening WDV as per Income Tax Act. In case of depreciable asset, don't take the book value, take the opening WDV as per Income Tax Act. In case of other than depreciable asset, take the book value. However, in the book value, if there is any revaluation, then remove the effect of revaluation. You should not consider revaluation while taking the net worth. Okay, so if there is any revaluation, you should remove the effect of revaluation. Then you have to reduce liability. Sir, how to take the liability? Take the liabilities at book value. So if you do asset minus liability, you will get the net worth. This net worth only will become cost of acquisition. It will become cost of acquisition. Sir, what if this net worth is negative? If this net worth is negative, don't take the negative value. Take the net worth as 0. If it is negative, take it as 0. Okay. Next, one more special point. If at all The assets contain any asset on which section 35 AD deduction is claimed. What is 35 AD deduction? Specified business deduction. All those things, for hotel, hospital of above 100 beds, and then warehouse for agricultural storage, cold chain facility, all those businesses. For all those businesses, if you have claimed the deduction under section 35 AD, then for such asset alone, you should take the value as 0 while calculating the net worth. Okay. Next, listen. How to find out whether the undertaking is a short term or long term? If the undertaking is held for up to 3 years, it will be short term capital asset. If it is held for more than 3 years, it will be called long term capital asset. How to calculate the period of holding? Period of holding should be taken from the date of incorporation or date of purchase till the date of slum sale. Till the date of slum sale. However, while calculating long-term capital gain, if at all the capital asset is a long-term capital asset, should you do indexation? Answer is no. You should not do any indexation for slum sale calculation. No indexation is allowed. Okay. Then if slum sale is calculated, if slum sale transaction is done, then report of a chartered accountant is compulsory, indicating and certifying the computation of net worth. Okay. So this is the provision of slum sale. One more time, just quickly I will go through slum sale, okay, because it is very important. What is slum sale? Slum sale means an undertaking as it is transferred to another company for a lump sum consideration without assigning individual value of asset. How to calculate capital gain? Capital gain, in that you have to take full value of consideration. What is full value of consideration? FMV1 or FMV2, whichever is higher. FMV1 means the fair market value of the asset transferred. FMV2 is the fair market value of the consideration that is received. Take whichever is higher, and that higher value will become full value of consideration. From that you have to reduce the transfer expense, you will get the net consideration. From the net consideration you have to reduce the cost of acquisition. How to calculate cost of acquisition? You have to calculate the net worth. What is net worth? Net worth is asset minus liability. So in case of asset, if it is a depreciable asset, take the opening WDV as per Income Tax Act. If it is other than depreciable asset, take the book value but do not take revaluation. Then if it is an asset on which 35 AD deduction has been claimed, take the value of the asset as 0. Then what about liability? Take the value of liability as book value. After you reduce asset minus liability, you will get net worth. If the net worth is positive, consider the positive value as cost of acquisition. If it is negative, then take the cost of acquisition as 0. Fine. If the undertaking is held for more than 3 years, it will be called long term. If it is up to 3 years, it will be called short term. However, if it is long term, there is no benefit of indexation. You get my point? I hope you are clear with section 50B slum sale. Now let us discuss section number 50C, that is cases where stamp duty value will be considered as full value of consideration. Listen Karna, when land or building or both is transferred from one person to another person, then if stamp duty value of the property is up to 110% of the sale consideration, then take full value of consideration as the sale consideration. However, if stamp duty value is more than 110% of sale consideration also, take full value of consideration as stamp duty value. For this, the detailed explanation I have given in class, but I am not going there once again. So listen very carefully. If stamp duty value is just up to 110% of sale consideration, full value of consideration can be taken as usual, sale consideration. But if stamp duty value is even more than 110% of sale consideration, take full value of consideration as the stamp duty value. Now comes the question, the sale consideration is there, no? The stamp duty value is there, no? Should it be taken on registration date or agreement date? Generally, you have to take the registration date. However, if on or before the date of agreement, if any consideration, it can be full consideration or part consideration, if it is received through account pay check, account pay bank draft, or electronic clearing system or any other prescribed mode, then you take the date of agreement. What did I say? Generally, take the stamp duty value as on the registration date. However, if on or before the date of agreement, if full or part consideration is paid through account pay check, account pay bank draft, or electronic clearing system or any other prescribed mode, in such case take the agreement date. Now listen here. Sometimes what will happen is the assessee will not be satisfied with the stamp duty value. He will think that the stamp duty value is a very high sum. So what he will do? he will request the assessing officer, and assessing officer will transfer the matter to valuation officer. He will transfer the matter to valuation officer. If valuation officer derives the value, and if that value is more than the SDV, stamp duty value, then no need to worry, take the full value of consideration as stamp duty value. But if the value derived by valuation officer is less than the stamp duty value, then full value of consideration will become value derived by valuation officer. It means the benefit can be taken by the assessee, but if there is any loss, it means you can ignore. So if valuation officer increases the amount, then you ignore it. But if he decreases the amount, you can take the benefit, and that value you can take as full value of consideration. You get my point? I hope you are clear. Now let us discuss about section 43 CA. Section number 43 CA. 43 CA is for PGBP chapter. It is the section in PGBP chapter. Then why are we discussing it here? Because, see, listen here. Section 50C deals with immovable property which are capital asset. 50C deals only with capital asset, and 43 CA deals with stock in trade. Deals with stock in trade. All the provisions in 50C and 43 CA both are one and the same. There is no change at all. Both the provisions 43 CA and 50C both are same. However, there is one small change in section 43 CA. One small change, that is the amendment brought out by Finance Act 2021. I told you, no, 110%, 110%. Listen here. If at all it is a case of 43 CA, it means what? A builder is having the stock as immovable property, and if the builder is selling the stock, then instead of this 110%, you can take 120%. Instead of this 110%, you can take 120%, where the builder is selling his stock. Okay, but this 120% you can take it only if three conditions are satisfied. Only if three conditions are satisfied. What are the three conditions? Condition number 1, the builder should transfer a residential unit between the period 12th November 2020 till 30th June 2021. Residential unit should be transferred between 12th November 2020 to 30th June 2021. Then condition number 2, it should be a first time allotment. It should be a first time allotment. And condition number 3, that the consideration received should be up to 2 crores. Consideration received should be up to 2 crores. If all these three conditions are satisfied, then when the builder is giving his immovable property, that is the stock, to the person who is receiving the property, then on the amount received he can take the tolerance band as 20%. That means in this calculation he can do the calculation using 120% of the sale consideration. You get my point? So this is a special point for section 43 CA alone, where the immovable property is a stock in trade. Fine. What is residential unit? Residential unit is nothing but a flat or apartment, etc. That means it is an independent housing unit where there are separate facility for living, cooking, sanitary requirement, which are separated from all the other residential units within the building. Okay, so I hope you are clear. Now let us discuss section number 50 CA. Full value of consideration in case of unquoted shares. So if they are unquoted shares means what? Unlisted shares or listed but rarely traded shares. So in case of unquoted shares, if the sale consideration is less than the fair market value, then full value of consideration will become the fair market value. If sale consideration is less than the fair market value, full value of consideration will be considered as fair market value. Now let's come to section 50D. Section 50D is what? If sale consideration cannot be determined. Sir, what if sale consideration itself cannot be determined? For example, I sold my house and I asked the buyer of the house to give me food throughout my life. To give me food throughout my life. In such case, I cannot calculate the value of the consideration that I received. In such case, I should take the fair market value of the asset that is transferred as the full value of consideration. On the date of transfer, whatever is the fair market value, I should take it as the full value of consideration. Now let us come to advance money forfeited, that is section number 51. If any advance money is forfeited on or after 1/4/2014, then it is fully taxable in the income from other sources head of income in the year in which the advance is forfeited. However, if any advance was forfeited before 1/4/2014, then you have to reduce such advance from the cost of acquisition. Reduce from advance from the cost of acquisition. Okay. Next, section 55A, reference to valuation officer. This is not so important, but however you give a reading of this section also. Next, capital gain at special rates. Now let us discuss the special rates for capital gain. Firstly, let us discuss about long-term capital gain. Generally, long-term capital gain is taxable under section 112. Long-term capital gain is taxable under section 112. Okay, what is the tax rate of 112? Answer is 20%. What is tax rate? 20%. However, if there is a resident individual or HUF, such resident individual or HUF can take the benefit of basic exemption limit also against the long-term capital gain. However, if there is any person other than resident individual or HUF, such person cannot take the benefit of basic exemption limit against long-term capital gain. You get my point? Next, if there is any long-term capital gain from listed security other than units and also zero coupon bonds which are not covered in section 112A, in such case the tax rate will be 10% without indexation or 20% with indexation, whichever is lower. What is the tax rate? 10% without indexation or 20% with indexation, whichever is lower. Now let's talk about a special case where a non-resident or a foreign company is having a long-term capital gain from unlisted shares of closely held company. If a non-resident or a foreign company is having long-term capital gain from unlisted shares of closely held company, then tax rate is 10% without indexation. 10% without indexation. So this is the normal rate of tax for long-term capital gain. Long-term capital gain is never taxed at normal tax rate. It will be taxed under section 112 at 20%. At 20%. Resident individual HUF can take the benefit of basic exemption limit. Other than resident individual HUF cannot take the benefit of basic exemption limit. Now let's come to short-term capital gain. Short-term capital gain is taxed normally at the normal tax rate. Normally, short-term capital gain is taxed at normal tax rates. Now we are going to learn two new sections, that is section 111A and 112A, which are special tax rates for long-term and short-term capital gain. Firstly, let me discuss that against 111A, 111A, 112 as well as 112A, against all these three sections, chapter 6A deduction will not be allowed. Chapter 6A deduction is not allowed against any special rate income. Okay, next. Basic exemption limit cannot be adjusted except in case of resident individual and HUF. And third one, for 112A alone, 87A rebate also will not be allowed. For 112A, 87A rebate will not be allowed. Now let us discuss what is given in section 111A. 111A talks about short-term capital gain on certain assets. What are those certain assets? So certain assets are number 1, equity shares of a company, units of equity oriented fund and units of business trust on whom STT is paid on transfer. If there is any equity share of a company, units of equity oriented fund or unit of business trust on which STT, that is security transaction tax, is paid on transfer, then on such asset if there is any short term capital gain, that short term capital gain is covered under section 111A and it will be taxed at 15%. It will be taxed at 15%. Okay, next. However, if it is a case of international financial service center, then you need not see this short security transaction tax and all. Okay, now let's come to section 112A, which talks about long-term capital gain on certain assets. Now what are the certain assets? Similarly here also, if there is any long-term capital gain on transfer of number 1, equity shares of a company, okay, units of business trust, units of equity oriented fund on which STT is paid on transfer, then they are also covered here in section 112A. But here one small change is there. Listen here. In case of equity share of a company, no, STT should also have been paid on acquisition. So in case of equity shares, if STT is paid on acquisition as well as transfer, only such equity share will be covered under 112A. Okay. Now, Kanna, what is the tax rate in 112A? The tax rate is 10% in excess of 1 lakh rupees. 10% is in excess of 1 lakh rupees. So for example, if 15 lakh rupees is the long-term capital gain, then you have to reduce 1 lakh. Then what is the balance amount? On that you can apply 10%. So the tax will be 1.4 lakhs. You get my point? And there is no indexation benefit allowed for section 112 2A. I already told you that indexation will not be allowed. What did I tell? There are 4 cases where indexation is not allowed. In the previous video, I have told you. What are the 4 cases? Case number 1 is indexation is not allowed for section 112A. Indexation is not allowed for section 50B, that is slum sale. Then indexation is not allowed for bonds and debentures other than capital indexation bonds or sovereign gold bonds. And then indexation is also not allowed where a non-resident is purchasing and selling the shares or debentures of an Indian company in foreign currency. Okay, so you should recollect all those and link everything together. Now let's come to a special concept of cost of acquisition. Cost of acquisition for 112A. Sir, in 112A there is a special concept for calculating the cost of acquisition because of grandfathering. Because of grandfathering. What is grandfathering? Grandfathering is before 1 February 2018, what used to happen is whatever transaction was covered under section 112A used to be fully exempt. But on or after 1 February 2018, what happened is, on or after 1 February 2018, what happened is 1 lakh rupees was exempt, and above 1 lakh rupees, whatever amount is there, it will be taxable as 10%, which we already studied. So the people got very angry. So what did the finance minister do? Finance minister told that up to 31/1/2018, that is the grandfathering date, up to 31/1/2018, whatever is the capital gain that is earned, it will be fully exempt. So now to include that grandfathering inside this provision, you have to calculate the cost of acquisition in a different style. Okay, so listen here. If any share or any security is acquired on or after 1 February 2018, then the cost of acquisition will be the actual cost of acquisition, which is nothing but purchase price. However, if any security is acquired before 1 February 2018, that is up to 31/1/2018, then what you should do? You should do step number 1. Fair market value on 31/1/2018 or full value of consideration, whichever is lower. Then take the whichever is lower amount and actual cost of acquisition, whichever is higher. This will only become the cost of acquisition. This will become the cost of acquisition. So for example, if fair market value as on 31/1/2018 is 35 rupees, sale value is 50 rupees, then take whichever is lower. Which is lower? 35. Then take whichever is lower, which is 35, and actual cost, that is 25, whichever is higher. Hence this 35 rupees will become the cost of acquisition. It will become cost of acquisition. Once again, I am not going in detail of the concept of grandfathering. I hope that you are remembering what is the concept. Now comes the question, sir, how to calculate this fair market value? How to calculate fair market value? Very simple, Kana. In case of listed security, fair market value will be the highest price quoted on 31/1/2018 on the recognized stock exchange. And if no trading took place on 31/1/2018, then see the preceding date in which the trading has taken place. On that day, what was the highest price will become the fair market value for this section. Next, what about units? In case of units, fair market value will be the NAV of unit as on 31/1/2018. Now let's talk about unlisted security. If the shares are unlisted as on 31/1/2018, then how to calculate the fair market value? You have to calculate by normal indexation. So cost of acquisition multiplied by cost inflation index of 1718, that is 272, divided by cost inflation index in the year in which it is first held, or cost inflation index of 2001 2002, whichever is later. If you're not able to remember all this, just ignore, it is not that important. Okay, so you have to find out the fair market value. Using the fair market value, you have to find out the cost of acquisition. That cost of acquisition only you have to use while calculating the capital gain under 112A. I hope you are clear with section 112A. Now let us move on to the next concept, that is the concept of section 54 series exemption. 54 series exemption. There are 6 exemption sections that are covered for your syllabus. Firstly, let us discuss section number 54. If one exemption you are able to understand thoroughly, all the remaining will become very simple. So first exemption, listen very carefully. When will the exemption apply? When there is a capital gain on sale of residential property and it is used for residential purpose. So for whom and all is this section applicable? It is applicable only for individual and HUF. What is the nature of asset that is transferred? It should be a long-term capital asset, being a residential house property, being land or building appurtenant thereto. So listen here, if an individual or HUF is having a long-term capital asset being a house property, and if that house property is transferred, and after that if new asset is purchased, what should be the new asset? New asset should also be a residential house property. In such case, exemption will be allowed. When will the exemption be allowed? If an individual or HUF is having a long-term capital asset being a house property, if they are selling the house property and buying another residential house property, then exemption is available. And now listen here, if the capital gain amount is up to 2 crores, then the assessee can buy up to 2 house properties. Up to 2 house property. But if the capital gain value is above 2 crores, then the assessee can buy only 1 residential house property. And one more thing, this 2 house property point is there, no? This benefit can be taken only once in a lifetime. Once in a lifetime. Now let us see the time limit. I told you that new house property has to be purchased, correct? When to purchase this new house property? Answer is -1 plus 2 plus 3. -1 plus 2 plus 3. It means what? New house property should either be purchased within 1 year before or up to 2 years after the date of transfer. And if the new house property is being constructed, it should be constructed within 3 years from the date of transfer. So -1 plus 2 plus 3. If there is a new house, that new house should be purchased either 1 year within 1 year before or within 2 years after the date of transfer, and if it is being constructed, it should be constructed within 3 years from the date of transfer. Only then the exemption will be allowed. Okay, next, deposit scheme. Deposit scheme. Now listen Kanna, I told you that there is a time limit up to 3 years, 2 years or 3 years as the case may be, correct? Now when the return of income is being filed by the assessee, how will the government know whether the person is going to invest in new house or not? It will be very difficult for the government to know. So what does the government tell? The government will tell you deposit the money of capital gain in capital gain account scheme. You deposit the money of the capital gain in capital gain account scheme. This is nothing but a special bank account. It is a special bank account in which the assessee has to deposit the capital gain. If the assessee is depositing the capital gain in the account scheme, it should be deposited within the due date of filing return of income. It should be deposited within due date of filing return of income. Then this deposit amount should be used only for that new house, constructing new house or purchasing new house within the time limit. What is the time limit? -1 plus 2 plus 3. Okay, within the new house, within the time limit, the assessee should use the money which is there in the deposit scheme to buy or construct the new house. If the assessee is not able to use the money, then the capital gain which was already exempt in that year will again become taxable. In which the time limit expires. So listen again, once again, very important. In section number 54, what the assessee has to do, if the assessee is selling the long-term capital asset being a residential house, okay, and he is purchasing another residential house, then exemption is available. What is the time limit to purchase or construct the new residential house? It is -1 plus 2 plus 3. Means within 1 year before or within 2 years after he should purchase the house, or within 3 years after the date of transfer he should complete the construction. Now during the year of transfer, it is very difficult to know whether the assessee will be investing or not. That is why the government is telling you invest the entire capital gain account in the capital gain account scheme, which is nothing but a special bank account. In this special bank account, money will be deposited, then assessee can use the money only for the specific purpose, that is buying the new house, correct? If the money is not used within the time limit, then what will happen? Then when the time limit is expiring, in that year the capital gain which was exempt earlier will become taxable once again. It will become taxable once again. I hope you are clear. Now, how to calculate the exemption? The exemption will be the capital gain amount or the cost of the new asset or the amount deposited in the capital gain amount account scheme, whichever is lower. You get my point? Next, now listen very carefully. the new asset should not be transferred up to 3 years. What did I tell you? The assessee should buy a new house, correct? Buy or construct a new house within 1 year before, 2 years after, or 3 years after. This new house is there, no? He should keep it at least for 3 years. He should keep it at least for 3 years. If he is not keeping it for 3 years, then what will happen? Then if new asset is transferred within 3 years from the date of purchase or construction, then the cost of the new asset will be reduced by the exempted capital gain. Whatever was the capital gain that was exempt earlier, you reduce it from the cost of that new property. Reduce it from the cost of new property. You get my point? So I hope you are clear with section number 54. If this you are clear, all the others will become very simple. Now let us discuss next section, that is section 54B. Capital gain on sale of urban agricultural land and used for buying another agricultural land. This section is also applicable only for individual and HUF, and it does not matter whether the urban agricultural land is a short-term or long-term capital asset. It does not matter. But what matters? The urban agricultural land should be used by the individual or his parents for agricultural purpose during 2 years before the date of transfer. Now listen very carefully. There should be an individual or HUF. That individual or HUF is having a urban agricultural land which they should be using for agriculture purpose at least 2 years before the date of transfer. 2 years before the date of transfer. Now, if they are selling this agricultural land and buying a new agricultural land, okay, the new agricultural land can be rural also, it can be urban also, it does not matter, then exemption is allowed. What is the time limit to buy the new agricultural land? Answer is +2. 2 years. From 2 years within the date of transfer, the new agricultural land can be purchased. If the new agricultural land is purchased, then what will be the capital gain exemption? The exemption will be capital gain amount or cost of new asset or amount deposited in the capital gain account scheme, whichever is lower. So here also capital gain account scheme is applicable as usual. Next, this new agricultural land also should not be transferred for at least 3 years. So the assessee should keep this new agricultural land at least for 3 years. If it is transferred, then cost of acquisition of the new asset will be reduced by the exempt capital gain. You get my point? Next, section number 54D, compulsory acquisition of industrial land and building. So if this exemption section is applicable to all assessees and it does not matter whether it's a short-term or long-term capital asset. So listen here. If there is a compulsory acquisition of land or building which was used by the assessee for the business of industrial undertaking, industrial undertaking during 2 years prior to the date of transfer. For 2 years at least, if the assessee was using the land or building or both for industrial undertaking, and if it is compulsorily acquired by the government, in such case after compulsory acquisition, after receiving the compensation, with that compensation if they are buying another new land or building or both for industrial undertaking, then the amount of capital gain will be exempt. Okay, what is the time limit to buy the new land or building? Answer is +3, within 3 years from the date of receipt of compensation. So when they receive that compensation for compulsory acquisition, from that date onwards up to 3 years, within 3 years they have to buy new land or building or both for industrial undertaking. If they are buying, then their capital gain will be exempt. What will be the exemption? Answer is capital gain or cost of the new land or building or both, or deposit amount in the capital gain account scheme, whichever is lower. So hence in this section also, since 3 year is the time limit, capital gain account scheme will be applicable. Okay, deposit scheme will be applicable. Now let's talk about the next section, that is section number 54 EC. Section 54 EC also very simple, investment in certain bonds. The section 54 EC is applicable to all assessees and it is applicable only in case of long-term capital asset, long-term capital gains which arises on transfer of land or building or both. So if an assessee is having land or building or both, and if the assessee is transferring such land or building or both being a long-term capital asset, then if the assessee is buying bonds, then the value of such bond can be claimed as exemption. What are all the different types of bonds? Answer is National Highway Authority of India bonds, Rural Electrification Corporation Limited bonds, Power Finance Corporation Limited bonds, Indian Railway Finance Corporation Limited bonds. So NHAI, RECL, PFCL, RFCL. NHAI, RECL, PFCL, RFCL. If the bonds of these four companies, any of these four companies are purchased and the bonds lock-in period is 5 years, you cannot take the money out of the bond for at least 5 years. In such case, up to 50 lakh rupee capital gain will be exempt. Up to 50 lakh capital gain will be exempt. However, what is the time limit to buy the bonds? The time limit is within 6 months from the date of transfer. Within 6 months from the date of transfer, you have to buy that bond. Hence, in this section, capital gain account scheme is not applicable because it is just 6 months which is the time limit. That is why capital gain account scheme is not applicable. Now listen very carefully. In case of conversion of capital asset into stock in trade, no, capital gain is taxable only in the year in which the stock is sold. That is why the 6 months time limit should be taken from the date of sale of stock. And even in case of compulsory acquisition, 6 months time limit should be taken from the date on which the compensation is received by the government. Okay, but in this section deposit scheme is not applicable since the time period is just 6 months. Just 6 months. Now how to calculate the exemption? Exemption will be the capital gain account amount or cost of new asset, that is the bonds, whichever is lower. Okay, maximum 50 lakhs. Maximum 50 lakhs. More than 50 lakhs, assessee cannot claim exemption under this section. Now, I told you, right, the bonds have to be at least kept for 5 years. Bonds have to be kept for 5 years. Sir, within 5 years itself, if the bond is sold to some other person, or even if some loan is taken against the bond, then what will happen? Then, if new asset is converted into money within 5 years from the date of acquisition, then the exempt long-term capital gain will again become taxable in the year of such transfer or conversion. Then the capital gain which was already allowed as exemption will now become taxable in the year in which such bond is sold or money is taken on behalf of the bond. Okay, I hope you are clear. Next, let's discuss section 54F. When does 54F arise? 54F also allowed only for individual or HUF. When does 54F arise? When any long-term capital asset other than residential house is sold and on behalf of that a residential house is being purchased. What happens? And for an individual HUF, if the individual or HUF is having any long-term capital asset other than residential house, and if he is selling that long-term capital asset and buying or constructing a new residential house, then this section will be applicable. What is the time limit for the new residential house? -1 +2 +3. That is from the date of transfer within 1 year before or 2 years after he has to purchase the house, or within 3 years after the date of transfer he has to finish the construction of the house. Only then this section will be applicable. Now listen. Is deposit scheme applicable? Answer is yes. So within the due date to file the return of income, if the amount is not invested, then he can put the amount is in capital gain account scheme. Okay. Now in this section, it is a very different section. Generally, it is expected that capital gain amount should be invested. But in this section alone, that is 54F, it is expected that the assessee should invest the entire full value of consideration. Entire full value of consideration. Sir, what if entire full value of consideration is not invested? In such case, proportionate exemption only will be allowed. How to calculate the proportionate exemption? So listen here. Proportionate exemption is equal to cost of the new house multiplied by capital gain divided by net consideration. Cost of new house multiplied by capital gain divided by net consideration. This will be the exemption. Now listen. This new house also should not be transferred at least within 3 years. If it is transferred within 3 years, then exempt capital gain will be taxable once again in the year of transfer of the new asset. Now let us discuss section number 54EE. Section 54EE. If any person is having any long-term capital asset, if that is transferred, and on behalf of that amount, if he is getting units of a fund that is notified by central government, then that unit of fund should be purchased within 6 months from the date of transfer of the original asset, maximum 50 lakh rupees. In such case, what will happen? Capital gain or cost of new asset, whichever is lower, will be exempt from tax. This also should not be transferred at least within 3 years. If it is transferred within 3 years, then the capital gain which was exempt earlier will become taxable once again. So these are the 6 exemptions. Now let us see some additional point for section 54F. For section 54F, there is one more condition, that the assessee should not own more than one residential house. Assessee should not own more than one residential house. Next, assessee should also not purchase any other residential house within the time period, that is 3 years, other than the new asset. If this condition is not satisfied, then also exempt capital gain will be taxable again in the year of purchase of or construction. So what they are telling, that while this transaction is happening, assessee should own maximum one house, and even after buying the new house, okay, first what did we see, that the new house should be kept at least for 3 years, and within this 3 years he should also not buy any other house, that is given in this section. Okay, so I hope you are clear with the exemption section also. Now lastly, let us discuss capital gain on depreciable asset. Section 50 deals with capital gain on depreciable asset. Firstly, let us talk about depreciable asset on which WDV method will apply. Sir, when will capital gain arise? Capital gain will arise in two cases. Case number 1 is where the selling price is greater than the WDV of entire block. Selling price is greater than WDV of entire block. And number 2, when all the assets of the block are transferred. When all the assets in the block are transferred. So only in two cases capital gain will arise in case of depreciable asset. How to calculate capital gain? Very simple. Full value of consideration minus, take the opening WDV plus additions. So full value of consideration minus opening WDV plus addition. Okay, you will find out the capital gain. Now this capital gain or capital loss is always short term. So if there is a depreciable asset and that is transferred, and if capital gain arises on the depreciable asset block, it will always be short term capital gain. However, listen here, though the capital gain is always short term, if the asset inside the capital gain, okay, was a long term capital asset, then you can take the benefit of section 54 EC or the other exemption sections also. You get my point? We saw many exemption sections before this. For those exemption sections, certain exemption are applicable only for long term capital asset. But I told you, if depreciable asset are sold, in such case the capital gain will always be short term capital gain, or capital loss will always be short term capital loss. But does it mean that they cannot get the benefit of 54 series exemption? Answer is no. If the asset inside the depreciable asset block was used for long term purpose, then they can get the benefit of exemption also. If you understood, well and good. If you did not understood, ignore. Okay, now let us talk about SLM method. SLM method is what? Straight line method. So straight line method, if it is followed, then three cases can happen when the capital asset is sold. First case is where selling price is less than the WDV. If selling price is lesser than WDV, then selling price minus WDV will be called terminal depreciation. This terminal depreciation is allowed as a deduction in PGBP head of income. It is allowed as deduction in PGBP head of income. Next case is selling price is greater than the WDV. If selling price is greater than WDV but less than the cost price, then selling price minus WDV will become balancing charge. This balancing charge is considered as income under PGBP under section 41. Okay. Next, third case. What is the third case? Selling price is greater than cost price. If selling price is greater than cost price, then there are two amounts that you have to calculate. Cost price minus WDV will be called balancing charge, and it will be considered as income under PGBP. And next one, selling price minus cost price will become capital gain. Selling price minus cost price will become capital gain. So listen here, in case of SLM method, capital gain will arise only and only if the selling price is more than the cost price. Selling price is more than cost price, and the amount of difference will become capital gain. There is no concept of capital loss for straight line method. Only capital gain will arise. The other cases are there, no? Wherever there is a loss, all that is covered in PGBP itself. You have to claim a deduction or you can claim it as income as the case may be. I hope you are clear with SLM method of depreciable asset also. Fine. Okay, let's come to exemptions now. So section 54, we had learnt about exemptions under section 54 series, so 54, 54B, 54D, etc. Now in section 54, which is capital gain on sale of residential property and used for residential purpose, and the new asset should also be a residential house property. In such case, what is the new provision? The new provision is that the maximum exemption has been limited to 10 crore rupees. Maximum exemption is how much karna? 10 crore rupees. It means what? The cost of the new asset maximum should be 10 crore. Sir, what if it is 100 crore? If it is 100 crore, the cost of new asset, if it is 100 crore, then you should calculate as only 10 crores. You get my point? In your capital gain calculation, if the cost of new asset is 100 crores, you should take as maximum 10 crores only and do the capital gain calculation. Similarly, sir, this CGAS, capital gain account scheme is there, no? In that also, the maximum amount allowed is 10 crore rupees. More than that, if you deposit in CGAS, that is capital gain account scheme, it will not be considered under Income Tax Act. You deposit, that is not a problem. But in income tax, you will not get any benefit for that deposit. Fine. Similarly, even in section 54F, when you do the calculation, section 54F is what? You sell any long-term capital asset and after selling, you use the entire money to buy a residential house property. Correct? One residential house. Not the capital gain, entire money. Here the concept is a little different. Now here also, this residential house that is to be bought, its value also can be maximum 10 crores. Maximum 10 crores. If the value of that house is more than 10 crores, you should consider only 10 crores. You get my point? And here also, in capital gain account scheme, the maximum amount is 10 crores. The government does not want to give benefit to super rich people who are having crores and crores of capital gain and escaping by selling one property and buying another property. They wanted to restrict this exemption only to the middle class, upper middle class people and to a certain extent of capital gain. They do not want to give this benefit for the higher amounts. Fine. So this change is there. And now let us discuss a brand new section, that is section 50AA, computation of capital gain in case of market linked debenture and specified mutual fund. Okay, market linked debenture and specified mutual fund. Firstly, let us know what is this market linked debenture and what is this specified mutual fund. Specified mutual fund, let us see. It is a mutual fund where not more than 35% of the total proceeds is invested in equity shares of the domestic company. See Kanna, there is a mutual fund. Okay, there are two types of mutual fund: equity mutual fund and debt mutual fund. Equity mutual fund means minimum 65% should be there in equity. Fine. And debt mutual fund means 65% should be there in debt. Fine. Now in this case, see here, a mutual fund where not more than 35% is invested in equity. So maximum equity percentage is how much? 35%. It means what? Minimum debt percentage is how much? 65%. Maximum 35 equity. It means what? Minimum 65 debt. It means specified mutual fund is nothing but a debt mutual fund. Where not more than 35% means max to max 35% is invested in equity shares. And how is this 35% calculated? This 35% is calculated by taking the annual average of the daily closing figures. So every day they will take the closing amount and they will take the average of the closing amount of all the days in the year and then they will decide the percentage. This is how the percentage is calculated. This is specified mutual fund. Now let us see what is market linked debenture. Market linked debenture is a security which has an underlying principal component in the form of a debt security and where the returns are linked to market returns on other underlying security or indices. Fine. It includes any security classified or regulated as a market linked debenture by SEBI. So it means what, Kanna? Market linked debenture is also debenture. Debenture means what? It is a type of security that represents a loan or a debt. Correct? But here what is different? Generally, if there is a debenture, the debenture will have an interest rate. Correct? Let's say 7% debenture, 8% debenture, 9% debenture. However, in case of market linked debenture, the debenture will not have a fixed interest rate. Instead, the interest rate will depend on the market condition. It will depend on market condition. Market condition means any other security in the market or indices. Indices means what? Example, Nifty or Sensex. All these are indices. Also, if SEBI is telling that a security is a market linked debenture, then you should also consider it as a market linked debenture. Now, let me give you an example. If you want, you can note this down also to have more clarity. Example, A Limited issues a market linked debenture which gives 10% return if the Nifty 50 does not fall by more than 20% during the tenure of the market linked debenture. If it falls, then no return will be given, only principal amount will be repaid. Let me explain. So this A Limited is there, no? It has given a debenture. Let's say the value of debenture is 1 lakh rupee. Okay, and it is given for 5 years. 5 years. Now what are they telling? If at all the value of Nifty 50. Nifty 50 is what? It is an index. If the value of Nifty 50 goes below 20%, so let's say while issuing the debenture, the value of Nifty 50 was 20,000. Okay, the value of Nifty 50 was 20,000. Now what are they telling? The Nifty 50 price should not go down by more than 20%. 20% is what? 4,000. So it means what? During this 5 years, Nifty 50 should never touch 16,000. If it goes below 16,000, then this A Limited will not give any interest. However, if during this entire 5 years, not even in a single day, Nifty 50 goes below 16,000, then A Limited will give 10% interest. You get my point? Sir, what if there is no interest? It means that only principal repayment will be there. At the end of 5 years, you will get back the 1 lakh rupees, but you will not earn any interest at all. You get my point? Such type of debenture is called market linked debenture. Fine. Now, what happens, no Kanna? This market linked debenture and specified mutual fund, okay, both of them are actually debt instrument. Specified mutual fund also contains minimum 65% in debt. Okay, maximum 35% equity means what? Minimum 65% in debt. Similarly, even this market linked debenture is a debenture. However, this specified mutual fund and market linked debenture are both traded in the stock exchange. For this mutual fund also, daily NAV will be calculated. Correct? And for market linked debenture also, it can be traded in stock exchange. Traded in stock exchange. You can buy a market linked debenture from stock exchange. You get my point? It means what? It means that even though it is a debt, okay, the value of debt never changes. It will remain constant. Correct? Since the incremental value is given in the form of interest. See here, if there is a debt, okay, will the value of debt increase? Answer is no. The value of debt will not increase, it will always remain the same because the debt value is given in the form of interest. This I have already explained you when I was explaining you why there is no indexation allowed on debentures and bonds. That time I had explained you this concept. Now listen here. Even though the value of debt does not increase, but still they are traded in the stock exchange. This market linked debenture and specified mutual fund. Correct? They are traded in the stock exchange. Now, why will some person buy this from the stock exchange? They will buy this only because the price can increase or decrease in the stock exchange. It means what? The only intention of the person buying a market linked debenture or a specified mutual fund is that they can buy for a low price and sell for a high price. This is called speculation. This is called what? It is called speculation. It means you are not concerned about anything else. You just want to buy in a lower price and sell at a higher price. You are not interested to invest in the company. You are only interested to make profit on price fluctuation. The government wants to treat this speculation as business income. But since these both are capital asset, they cannot take it to PGBP. Okay, that is why they have introduced section 50AA. Now look here, section 50AA. Transfer of unit of specified mutual fund or market linked debenture. Section 50AA provides for the computation of capital gain in case of transfer of unit of a specified mutual fund acquired on or after 1/4/2023. So this is applicable only if the specified mutual fund is purchased on or after 1/4/2023. Very important. This entire section is very important karna. I am expecting that a question will come in either May 24 or November 24. May 24 an MCQ might come, and in November 24 a full-fledged question can come. Fine. And market linked debenture. Section 50AA will have an overriding effect in spite of anything contained in section 242A, which defines a short-term capital asset. Now what are they telling? The section is telling that a specified mutual fund or a market linked debenture will always be considered as what? Short-term capital asset. Why? Because if they consider this as long-term capital asset, you will claim indexation, then your profit will reduce or capital gain will reduce and you will pay reduced tax. Correct? Hence, they are telling that whatever the period might be, it will always be considered as short-term capital asset, and it is overriding section 242A. So here also I want you to make a note. Come to section 242A, where we discussed about short-term capital asset and long-term capital asset. In page number 10.8, I want you to note here period of holding concept. Note, as per section 50AA, specified mutual fund and market linked debenture are always considered as what? Short-term. Please pause the video, write down the provision and then unpause the video. Okay? Done? So since it is only considered as short-term capital asset, the capital gain will also be called what? Short-term capital gain, and the tax applicable is normal rate of tax. Sir, how to compute capital gain? Capital gain is computed in the normal manner kana. First you have to take full value of consideration. Full value of consideration, it means what? Selling price of market linked debenture or specified mutual fund. Selling price. Then you can reduce transfer expense. Correct? Then you will get net consideration. From this net consideration, you can further reduce what? Cost of acquisition. This cost of acquisition, is indexation allowed? Answer is no. No indexation, since it is always short term. Cost is always what? Short term. After reducing the cost, you will get short term capital gain or short term capital loss. You get my point? So this is the concept. And sir, I told you that the government wants to consider this as a business. since it is only speculation. There is no point of investment in case of market linked debenture, etc. That is why you might think that STT and CTT might be allowed. STT and CTT might be allowed. However, since this is capital gain chapter, STT CTT is not allowed as deduction. Here CTT will not be applicable, only STT will be applicable. So STT is not allowed as deduction. Nowhere in capital gain STT is allowed as deduction. Hence, even in this section, STT will not be allowed as deduction. So let me summarize this section once again. If there is a capital asset called market linked debenture or specified mutual fund. What is a market linked debenture? Market linked debenture is a debenture whose return is dependent on the market, or if it is called as a market linked debenture by SEBI. Fine. What is a specified mutual fund? Specified mutual fund is a mutual fund in which maximum 35% only should be equity. Okay, and it should be purchased on or after 1/4/2023. If you have such capital asset, then it is always considered as short term capital asset, and the capital gain also will be considered as short term capital gain, and it is subject to normal rate of tax. Okay, normal rate of tax. How will you compute capital gain? Take full value of consideration, reduce the transfer expense, and you will get net consideration. From this you should reduce the cost and you will get the short term capital gain or short term capital loss, and no STT is allowed as deduction in case of section 50AA also. Fine. So with this, continuously we have seen all the different special cases in capital gain chapter. I hope you were able to revise it quickly, and there is loads and loads of concept involved in this particular video. So even if you did not grasp the entire concept within the first watching, I would recommend you to watch this video once again. If you want, you can speed the video or make the video faster and watch it. You will be able to understand clearly. After this, solve the questions in your study material. You will be good to go and you will rock in your examination. Wish you all the best, dear. See you in the next video. Till then, take care. Bye bye.